Last lesson, we have introduced the US Treasury bill, how its price is quoted in the market, and the relevant concepts of the discount rate and the investment rate. In this lesson, we will learn how the quoted price of the Treasury bond is calculated. Now let's introduce the concept of day count conventions. A day count convention is a counting system used to determine the number of days between two coupon dates. As interest accrues daily, it is important to know the day count convention applicable for a specific bond. Handling the day count issue correctly is critical to any financial software that handles bonds. In the actual over actual day count convention, the first actual refers to the actual number of days in a month, and the second actual refers to the actual number of days in a year. The 30 over 360 convention is common among corporate and municipal bonds. Each month is assumed to have 30 days, and each year 360 days. Another popular convention is actual over 360. In this case, we use the exact number of days in the month, but assume there are 360 days in a year. Now we're ready to calculate bond price between two coupon payments. First, let's record the typical bond price formula. In this formula, capital F is the face value, capital C is the coupon payment, and N is the number of coupons, M is the number of payments per year, and R is the annualized yield to maturity, which is compounded M times per year. This formula assumes that the next coupon payment is exactly one period from now, and the previous coupon, if there is any, has just been paid. In reality, bond price computation has to be done for any day within the coupon period. Next, we're going to see how the accrued interest is calculated with the given day count convention. Let W be the number of days between the pricing date and the next coupon payment date over the number of days in the current coupon period. Here, the number of days is counted based on the day count convention applicable to the bond in consideration. Then, the bond price can be calculated by the following formula. Note that W can be regarded as a fraction of a complete coupon period. Thus, this formula calculates precisely the present value of the future cash flows incurred for the buyer. And this price is known as the full price, dirty price, or invoice price. However, the quoted price for bonds in the United States does not include the accrued interest, and is also known as the clean price or flat price. Let's consider a bond sales transaction. After the transaction, the bond issuer will send the next coupon to the buyer, but not the seller. Thus, the buyer has to pay the seller part of the coupon earned for the time period the bond was held by the seller. The convention is that the buyer pays the quoted price plus the accrued interest calculated by C times 1 minus W. Thus, we have the invoice price equals to the quoted price plus the accrued interest. Here's an example. Consider a bond with a 10% coupon rate and paying interest semi-annually. The maturity date is March 1st, 2015, and the settlement date is July 1st, 2013. The day count convention is 30 over 360. Given that the bond yield to maturity is 3% on the settlement date, can you determine the invoice price and the quoted price of this bond? Below is the timeline for this bond. Note that the settlement date, July 1st, 2013, is in between two coupon payment dates. By the 30 over 360 convention, There are 60 days between July 1st, 2013, and the next coupon payment date, September 1st, 2013. Therefore, we have W equals to 60 over 180, that is 1/3. And for each $100 face value, with 10% coupon rate, paid every half a year, the accrued interest for the seller can be calculated as follows. And the full price, or the invoice price, can be obtained by the formula given earlier. Subtracting the accrued interest from the full price, we can get the quoted price, or the clean price for this bond. Up to now, we have finished the section on the fixed income instruments. In particular, we have learned how the prices of the US Treasury bills and Treasury bonds are quoted in the market. We will proceed to the section on interest rate futures from the next lesson.